Welcome to Iron Financial. Here, our mission is simple: to forge stronger portfolios. We do that by stress testing the market's weakest links to find out if there's solid steel opportunity hiding underneath. And today, the company we're putting under the microscope is the Simply Good Foods Company, ticker SMPL. We're going to put this thing through the crucible and see if it bends or if it breaks. All right, let's get into it.
Look, let's not waste any time here. This stock has been absolutely annihilated. We are talking about a 63% collapse from its 52-week high. I mean, that is a brutal, punishing decline that has just wiped out an immense amount of shareholder value. So the question we have to answer today, it's simple, but it is absolutely critical. Is this a fallen titan, a structurally sound company that's just been oversold in a panic? Or is it a classic value trap, a crumbling structure that's just going to collapse on anyone who dares to step inside? Okay, can I just jump in here? I have to. 63%. The market hasn't just spoken. It has screamed bloody murder on this thing. We're talking about a full-blown investor exodus. I mean, we're not just sifting through a little bit of rubble here. We're looking at a company that Wall Street has, for all intents and purposes, condemned. To me, this looks less like a foundation and a lot more like a sinkhole.
And you know what? That's exactly why we're here. Because our job is to question that consensus, to run the numbers ourselves, and to see if there is steel where everybody else just sees rust. So here's our battle plan for today. First, we're going to check the stock's pulse right before that earnings report. Then, we're going to deconstruct the numbers piece by piece. After that, we'll dive into what I'm calling the brand civil war inside the company. Then, we'll analyze Wall Street's total confusion, dig deep into that impairment charge and the forward guidance, and then we're going to deliver the iron financial verdict. No ambiguity, no maybes. Let's get to work.
First things first, we've got to set the scene. Heading into its absolutely pivotal Q2 earnings report back on April 9th, the pressure on Simply Good Foods was, well, it was immense. This wasn't just another routine quarterly check-in, not by a long shot. This was a moment of truth for a company whose entire structural integrity was being called into question by the market. The sentiment out there was overwhelmingly, profoundly negative.
And this number really says it all, doesn't it? A 63% drop from the 52-week high. You have to understand, this isn't just a market correction. This is a complete and total capitulation. Every single ounce of optimism had been squeezed out of the stock, leaving behind nothing but deep, profound pessimism. The sheer weight of that number tells you everything you need to know. The market wasn't just expecting bad news. It was expecting the absolute worst.
And let's be crystal clear about this. This wasn't some slow drift downwards. This was a free fall. The stock hit a brand new 52-week low, $13.62, right before this report dropped. We're talking about a company scraping the absolute bottom of the barrel here. You know, when you're trading at lows like this, it means the market doesn't just think you're having a bad quarter. It thinks your entire business model, your very reason for existing, might be fundamentally broken. So no, this wasn't just a dip. It was an absolute crisis of confidence.
All right, so with the stock flat on the mat, the earnings bell finally rang. Now, we deconstruct the report. We have to see if these numbers provided any kind of solid foundation to rebuild on, or if they just revealed even more cracks in the armor. We're going right into the core data now to separate the signal from all the noise.
So, just look at this table. The first thing that should jump out at you is the immediate contradiction. I mean, it's staring us right in the face. On one hand, you have the adjusted EPS, which I've highlighted. It comes in at 45 cents, absolutely smashing the 40 cents estimate. That's your headline beat that got some attention. But then, your eyes drift up to the revenue line, $326 million. That was a huge miss against the nearly $346 million that Wall Street was looking for. So right out of the gate, you have this completely conflicting story. They're somehow making more profit than expected, but on far, far less sales. It doesn't quite add up.
Whoa, hold on a second. A beat? Are we just going to gloss over the real number on the page here? $249 million. That is the non-cash brand impairment charge they tried to bury deep in the footnotes. How can you possibly, with a straight face, claim you beat anything when you're simultaneously writing down the value of your core assets by $250 million? That's not a beat. That is a bombshell that blows the entire positive narrative to smithereens.
And that's a completely fair challenge, which brings us to this absolutely crucial distinction. So you have GAAP earnings, that stands for Generally Accepted Accounting Principles, which includes everything the good, the bad, the ugly, and yes, that massive impairment charge. Under GAAP, the company posted a giant loss of $1.73 per share.
You mean the real result?
The real result, exactly. Now, the adjusted or non-GAAP number, that's what management wants you to focus on. They strip out what they consider to be one-time or unusual items to show you what they call the core operational performance. In this case, that meant pretending that a $250 million write-down just didn't exist, to magically arrive at a positive 45 cents. Here's the key insight for any investor. When a company's adjusted story is this wildly different from its GAAP reality, you have to start asking what management is trying to hide.
It's financial engineering. It's financial gymnastics, plain and simple. They're not just covering up a crack in the wall, they're trying to throw a giant Persian rug over a sinkhole in the living room. You can't just ignore a $250 million problem because it's inconvenient for the story you want to tell.
And you're absolutely right to be skeptical, because even if we play their game and ignore the impairment for just a moment, the other core metrics are flashing bright red warning lights all over the dashboard. This isn't about one accounting charge. The gross margin collapsed by 460 basis points year over year, down to just 31.6%. That means the actual profitability of the stuff they sell is getting hammered. Then you look at adjusted EBITDA, another key measure of operational health. It was down over 18%. So even when you use their preferred adjusted lens, the picture is one of serious systemic decay. These are not the signs of a healthy structure. This is clear evidence of significant operational stress.
So the big question is, why are the numbers so conflicted? Why is everything pointing in different directions? Well, to understand that, we have to look inside the company itself. What's happening at Simply Good Foods isn't a simple story of across-the-board decline. It is a tale of two warring factions within its own brand portfolio. A civil war is literally raging, and it's tearing the entire income statement apart.
Okay, so on one side of this war, you have the growth engines, the Quest brand and the recently acquired Owen brand. I mean, these brands are firing on all cylinders, posting strong double-digit consumption growth. They are riding this massive consumer wave that all the analysts are calling the protein megatrend. These are the new, strong, load-bearing walls of the company. This is the future, a future that's being drowned by its own past. On the other side of the battlefield, you have Atkins, the legacy brand. And listen, it's not just weak, it's in a state of catastrophic decline. We are talking about high single-digit, sometimes even double-digit drops in consumption. This isn't just an anchor, it's a giant block of rusting, dead weight, and it's chained to the company's ankles as it tries to swim. I mean, how can you possibly build a new skyscraper on top of a crumbling, rusting foundation? It doesn't matter how strong those new walls are if the very ground beneath them is giving way.
You know, this internal conflict you're describing, this brand civil war, it's perfectly mirrored by the so-called experts over on Wall Street. They are completely and utterly divided on this name. There is zero consensus. For every single analyst out there saying this is a steel beam skyscraper in the making, there's another one screaming that it's a house of cards in a hurricane. This isn't just disagreement. This is a street divided right down the middle.
And this slide just lays that division bare. I mean, just look at the chasm between these price targets. It's enormous. On the low end, you've got UBS with a $16 target, which is basically saying the stock is dead money from here, maybe even has some downside. Then, somewhere in the middle, you have Jefferies, who sees some decent upside at $22. But then you've got Bernstein all the way out there at $30. That would be more than a 100% return from the lows. This isn't a minor disagreement over a few bucks. They are living in fundamentally different realities. They are looking at the exact same structure and seeing completely different things.
So let's really look at the bull case, which is championed here by Jefferies. Their argument is structural and it's very long term. They're essentially saying, hey, ignore the short-term noise of the Atkins brand collapsing, focus on the real, enduring asset here, which is Quest. This is the kind of thinking that gets an analyst at a firm like Bernstein to go out on a limb and slap a $30 price target on this stock. They see the market punishing SMPL for yesterday's business, which is Atkins, while completely missing the massive value of tomorrow's growth engine, which is Quest, a brand that is perfectly positioned to capitalize on what looks like a permanent shift in consumer behavior toward protein.
Okay, and then you get the reality check from UBS. This is the bear case, and it is grounded in the here and now, in cold, hard facts. They're not looking at some far-off megatrend in the clouds. They're looking at the actual sales numbers going through the register. And what they see is a 6% organic sales decline. They are warning investors, point blank, that the bleeding on the top line has not stopped. Their view is simple: you can't build a beautiful house for the future when your current structure is actively taking on water and the foundation is sinking. The immediate top-line damage is just too severe to ignore. This is about surviving today, not maybe thriving in some hypothetical tomorrow.
Okay, so we've looked at the conflicting present. We've seen the battle lines. Now, let's try to look at the future, but through the company's own eyes. We're going to examine their own forecast and what that massive $249 million impairment truly signifies about their own confidence in the company's structural future. This is what they think is going to happen.
You know, it's so critical to understand what this actually is. A brand impairment isn't just some abstract accounting entry that you can ignore. It is a direct admission from management. They are officially stating, on the record, that the future earnings power of assets like the Atkins and Owen brands is significantly less than they previously believed and told the market. They are literally marking down the value of their own brands on their own books because they no longer believe they can generate the profits they once promised investors. This is nothing short of a public declaration of diminished expectations for the future.
And if that impairment was the quiet admission of guilt, then this new guidance is the signed, notarized confession. Just look at these numbers. They are guiding for net sales to be down somewhere between 7 and 10% for the full fiscal year. Let me repeat that, down 7 to 10%. This isn't stabilization, this isn't a turnaround story, this is forecasting continued painful decline. They are telling investors, in plain English, expect less revenue and expect less profit from us. How can anyone build a bull case on a foundation that the company itself says is going to be smaller and weaker a year from now? For me, this is the final nail in the coffin.
All right, we've laid out all the evidence, we've examined the cracks in the foundation, we've tested the load-bearing walls, and we have reviewed the company's own blueprints for the future. Now, it's time to weigh it all and deliver the iron financial verdict. We are going to forge a final, decisive conclusion on whether Simply Good Foods is a solid steel opportunity or a very dangerous financial trap.
Okay, let's summarize this thing. The bulls, they're hanging their hard hats on 4 key pillars. First, that adjusted EPS beat, which they say suggests some level of operational control. Second, the undeniable strength of Quest and OYN, which, let's be fair, are perfectly aligned with that protein megatrend. Third, the valuation. I mean, the stock is just plain cheap after a 63% haircut. And finally, there's a glimmer of hope that the returning CEO Joe Scalzo can right the ship.
But the weight on the bears side of the scale is just immense. The revenue miss wasn't small, it was a major gaping shortfall. That $249 million brand impairment is a massive vote of no confidence from management in themselves. The Atkins brand isn't just weak, it's cratering, and it's poisoning the entire portfolio. And then, to top it all off, the company's own forward guidance is explicitly telling us, hey guys, expect things to get worse before they get better. The bearish evidence feels like it's forged in solid steel, while the bullish case feels like it's built on a foundation of sand.
So here it is, our unified verdict. While the growth in the Quest brand is a legitimate and powerful structural support, we can't deny that, it is not yet strong enough to carry the entire dead weight of a declining Atkins brand and a management team that is publicly marking down its own assets and guiding for lower revenue. The cracks in this company's foundation are simply too deep right now, and the timeline for repairs is too uncertain. That headline DEET on adjusted EPS, it's a distraction. It's a fresh coat of paint on a rotting structure. Simply put, the risks of a complete structural failure here far outweigh the potential rewards of a turnaround. The company's own guidance confirms that the heavy lifting, the really hard part, has barely even begun. Until we see that top-line revenue stabilize, and, more importantly, until we see the freefall in the Atkins brand arrested, this is not an investment that is built on solid ground. And for that reason, the iron financial verdict is that Simply Good Foods, at this moment, is a value trap.
And that leaves us with the final critical question for you to consider as you construct your own portfolio. The protein megatrend is real, it's not going away, and the stock price is undeniably low. But are those two factors powerful enough to overcome the immense drag of a broken legacy brand and a company forecast that points directly to further decline? Can you truly rebuild a crumbling foundation while the storm is still raging all around you? That is the calculation every single investor looking at SMPL has to make. Thanks for joining us for this Iron Financial stress test.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.